Hello, everyone. I'm going to present our work using machine learning to conduct relative valuation. So relative valuation is really simple. You all know, like you use valuation multiples. You look at newspaper, they will tell you what's the P multiple of a company. So share price divided by earning per share, say 10 times, that's your P multiple, right? And then if you want to value a company based on how other companies traded in the market, you can look for comparable companies, or we call it peers, in the same industry. And you can also look for peers among firms with similar fundamentals, say growth rate and ROE. And sometimes you can combine both industry and firm fundamentals. How do I forward? Okay. Here, so this relative valuation tool question is perfectly suited for a tree-based method, gradient-boosted machines. So here's one tree we trained from GBM. So on the first node, it has, you split the samples into those with ROE above certain threshold and below. And then in the end node, you would have a leaf with a group of companies, and then that's naturally you compare comparable company or peers. Then you use the average of those comparable companies multiple to value the company you're interested to value, right? So, and then what we get as valuation result, we benchmark that with all the traditional models well known in the literature or used by academic and practitioners. The first three in the green box, that's machine learning models, and they generate much lower errors, which is not surprising, right? GBM is very powerful. But what is surprising is the fundamental drivers we use Shapley value. Sorry. Okay, we use Shapley value, which is a reason of advance in computer science, which on tree-based method you can accurately attribute the contribution from different variables to look at, okay, which variables are most important in the valuation process. And surprisingly, all these important variables picked by the machine conform with, what a professional would use, right, in discounted cash flow analysis. So professionals are trained and they know the discounted cash flow and finance theory, and then derived from the DCF, discounted cash flow model, there's some predictions which variables should matter, and the machines happen to pick almost exact the same important variables for different valuation multiples. Not only the valuation is accurate, and also across the timeline, you see that's the valuation errors. And the period that the machine struggles is around 2000, where the internet, we have internet bubble. So this is to say, during that period of time, a lot of assets potentially in the stock market are misvalued. And then after 2008, there's also a big spike in the valuation error. So that's where the machine struggles. Or from another perspective, is there's a lot of misvaluation in the market. So how can practitioners make use of this valuation error? If something is misvalued according to the machine, right, then it should revert to the fundamental value attributed by the machine. If you trade on the valuation error, we should generate return, positive profits that's not explained by the risk that the machine is bearing. Sorry. Okay, so here is the excess return from this trading strategy. If we buy those cheap stocks and short those expensive stocks, you have a very good excess return. Not because you're bearing more risk, that's just because the assets are misvalued. And also we conduct extreme demanding out-of-sample test. In the design, we already have out-of-sample test, but then we train it on public traded companies. Now we test it on IPO firms, and we can identify mispriced IPOs and generate excess return as well. So that's the paper, and I'm happy to discuss after, the session. Thank you.